Thank you, Vice Chair Clarida. I'd like to now introduce the moderator of the next session on monetary policy strategies, Dr. Adam Posen. Dr. Posen has been president of the Peterson Institute for International Economics since January 2013. During his presidency, the Peterson Institute has won global recognition as the leading independent think tank in international economics. Over his career, Dr. Posen has contributed to research on a wide range of public policy issues, including monetary and fiscal policies in the G20, the challenges of European integration, China-US economic relations, and developing new approaches to financial recovery and stability. Dr. Posen is also a co-author of Inflation Targeting, Lessons from the International Experience with Ben Bernanke, Thomas Laubach, and Frederick Mishkin. Please join me in welcoming Dr. Posen and the rest of the panel.
Good morning, everyone, and thanks to the Vice President for the very generous introduction. We are privileged that the gathering of the Fed's Communications Committee has become what it has become, which is an ongoing two-way engagement, not just with academics and pseudo-academics like myself, which is normal, but with the real people and the real businesses. And I want to commend the members of the committee for showing that leadership, and Ellen Mead, who played a key role in bringing this together, for making that happen. It's very visible, it's meaningful, and it's time. So kudos to the Fed for doing that. We obviously come to, in a sense, one of the most key panels. They're all important, but talking about monetary strategy is, in a sense, what a review is about. And we could not have two better speakers, both of whom are scholar practitioners. We'll be speaking first is Lars Svensson. All of you know Lars as the father and coiner of inflation forecast targeting, as an incredibly prolific and influential monetary economist, having taught long periods at the University of Stockholm and at Princeton. And of course, having served with distinction and as someone who's been on many losing votes, someone who pushed for losing votes as Deputy Governor of the Sveriges Riksbank, if you'll excuse my pronunciation. The discussant is Sharon Kozicki, and of course, she is advisor to the Governor of the Bank of Canada. She is secretary to the Governing Council, the Bank of Canada's policymaking body. Perhaps most importantly for today, she led the Bank of Canada's research in 2016 in the lead up to the renewal of the inflation target. And importantly also, she previously served at the Federal Reserve Bank of Kansas City and the Federal Reserve Board. So we're delighted to have them. Lars will present first for 25 minutes, and then Sharon will have 15 minutes for discussion, and then we will have open discussion. I'm being transparent. That's a clear signal. Go ahead.
Thank you very much. Sorry. Thank you very much, Adam, for this very kind introduction. I'm very grateful for the invitation to come here and participate and speak. And I share the appreciation expressed yesterday by several speakers, appreciation of the fact that the Fed has decided to undertake this review and taking it so seriously. We're all looking forward to the outcome of this. Okay, I will speak about monetary policy strategies for the Federal Reserve. First, excuse me, I think I need some. Okay, first, a bit of the background of the Fed's review, then about the Fed's mandate, flexible inflation targeting, about fulfilling the mandate, a general strategy of forecast targeting. With apologies to John, I will argue that it is actually better than a Taylor rule. Specific alternative strategies is next. I will talk about price level targeting, temporary price level targeting, average inflation targeting, and some conclusions. There is an appendix about nominal income targeting. I don't see that as a serious contender, but can talk about that if there are questions. Okay. The background for the review clarified in some detail in a speech by Vice Chair Clarida in the spring. We have seen a lower R star. It may stay low for many years to come. We probably see a flatter Phillips curve. And those are backgrounds for the review. Furthermore, the dual mandate and 2% as a target for the PCE, the deflator, is taken as given, and I will take that as given here. And then there are 3 questions. Here is the first question. Can the Fed best meet its statutory objectives with its existing monetary policy strategy, or should it consider strategies that aim to reverse past misses of the inflation objective? The second question, are the existing monetary policy tools adequate to achieve and maintain maximum employment and price stability, or should the toolkit be expanded? And how can the FOMC's communication of its policy framework and implementation be improved? I will mainly talk about question 1, touch a bit on question 3 when talking about forecast targeting, and not say anything about question 2. Okay, the Fed's mandate, we know it very well, maximum employment and price stability. If you simplify a bit and assume that the labor force participation rate is exogenous, you can focus on unemployment and the minimum long-run sustainable unemployment rate, U star. The FOMC has a balanced approach to fulfilling its dual mandate, meaning equal weight on stabilizing inflation around 2%, and unemployment around the estimated U star. And we can represent this by a standard loss function. The loss in quarter T is equal to the first term square deviations of the annual inflation rate from the target plus the squared deviations of unemployment from the U star. And pi here denotes the annual 4-quarter inflation rate. P is the log price level, the PCE deflator. Okay, forecast targeting. What is forecast targeting? Well, a starting point is we need to take into account 2 circumstances. First, that inflation and unemployment respond with a lag, and that second, the expectation of the future policy rate path matters. It's not really the current policy rate, it's really the expectation of the whole path that matters. Okay, given this, one can focus on forecast of inflation and unemployment and on the policy rate path. And forecast targeting then consists simply of selecting the policy rate and, importantly, the whole policy rate path, so that the corresponding forecast of inflation and unemployment look good. Look good means best fulfilling the mandate, best stabilizing inflation, the inflation forecast around 2%, and the unemployment forecast around the estimated U star. And then publish and justify the policy rate path and the forecast of inflation and unemployment in order to make them credible with the market and the general public. If needed, demonstrate that alternative policy rate paths lead to worse mandate fulfillment. Okay, I argue that this fulfills the mandate better than a Taylor-type rule, for it takes into account all relevant information, not just the current GDP and current inflation, The relevant information is information that affects the forecasts. You can say that new information is always filtered through the forecast. It allows for judgmental adjustments. Judgment is a combination it allows for a combination of model simulations and judgmental adjustment. Also, it can handle some technical issues. It allows for new situations, updating, learning, model uncertainty. It can also be modified to handle Woodford's commitment in a timeless perspective and other issues about discretion. Anyhow, it also allows the Fed to be held accountable and to be reviewed both in real time and after the fact, after the outcome of inflation and unemployment. The Fed is already practicing inflation, practicing forecast targeting to a considerable extent. It would be practicing it to a more or less complete extent if the SEP would report projections that are joint decisions by the FOMC instead of a snapshot of individual FOMC participants' projections. The techniques for doing this are already available. The Teal book is full of them. Here you see a few graphs which are exactly examples of the techniques needed. Let me move on to the specific monetary policy strategies. Forecast targeting can be used for any particular specific strategy. Let me talk about, so far we've talked about flexible annual inflation targeting. Then the alternative, flexible price level path targeting, temporary price level path targeting, and first flexible price level targeting, and then temporary price level targeting, and finally flexible average inflation targeting. Okay, if we take price level targeting, we have a loss function with deviations of the price level from a price level target. And the price level target is a target pass increasing at 2%. Now, when we look at annual inflation targeting, bygones are bygones. Inflation misses are not undone. Strictly, that should imply that the price level has what is called a unit root and starts looking like a random walk with drift. And the variance of the price level should be increasing without limit with the horizon. If you do price level targeting, past inflation misses are undone. The price level returns to the target path. As a consequence, the price level becomes stationary around the target path, and the variance over time is constant. This is in theory. What is the practice? Well, here you see Canada annual inflation and 5-year inflation on the left side, and you see the price level on the right side, and you also see a price level target path increasing by 2%. This looks pretty much like price level targeting. Here is Australia. Australia has a target of 2 to 3% over the median term. That also looks pretty good, like price level targeting. The euro area, also pretty good when you look at the right graph there. Sweden, unfortunately, is an embarrassment here. In the paper, I give a few references to papers that discuss why and what one could do about it, but I don't have time to deal with that here. This is the UK. You can see that the UK was different. It actually overshot inflation during the crisis. It's actually timed this very well. So when unemployment was high, the bottom line there, they actually overshot the inflation target and deviated upwards from the price level target. This was considered at the time as something involuntary and undesirable. We discussed this at length at Working Party 3 meetings that I took part in. But ex post, this was optimal policy, and one can congratulate Bank of England to having conducted such policy. Here is the US finally. This is the US, the PC core, looking fine up to the crisis. And here is when you plot both the PCE and the PCE core price level and inflation. And as we know, 2012, the Fed got an inflation target for the PCE inflation of 2%. Okay, so the practice is very different. Except for Sweden, it looks like price level targeting until the financial crisis, even into 2014 for Canada and the euro area. Canada is indeed special. Looking at a sample from 93 through the beginning of 2013, Ruge Murcia in a paper rejects a unit route for the Canadian price level and cannot reject that it's stationary around the target path. Several papers comment on why Bank of Canada looks like doing price level targeting. Possible reasons are small symmetric shocks or some inherent correcting behavior in the policy setting, for example, a high degree of interest rate smoothing. Not that Bank of Canada was covertly and consciously pursuing price level target. Flexible price level target. Why people like it, why it would be good, is that it has some automatic stabilization properties. If prices P go down and fall below the price level target P star, if people believe that the central bank will bring the price level back to target, inflation expectations will go up. The real interest rate R will, for given nominal interest rate I, actually fall. And this will stimulate the economy and bring unemployment down, which through the Phillips curve will bring inflation up and the price level up closer to the target. Also, there is a direct effect. If inflation expectations goes up through an expectations augmented Phillips curve, there is a direct effect on inflation, regardless of what is happening with unemployment and the unemployment gap. And this works well with the binding effective lower bound. And also, one can show in models with sufficient credibility, price level targeting reduces both inflation and employment or output or unemployment variability. It's like a free lunch. But it requires credibility, beliefs that the central bank will deliver. If little credibility, it's costly to bring the price level back after overshooting, for instance. Bank of Canada did a very thorough review in 2011. They found that it was not clear that conditions were satisfied for price level targeting to improve on inflation targeting. So the Bank of Canada did not take the jump. If it had, we would have been quite a bit wiser today. The private sector probably needs to see price level targeting in operation and see its principles obeyed by the central bank for credibility. Credibility needs to be earned by the policymakers. We learned that for inflation targeting. A temporary price level target when the effective lower bound binds. The next alternative strategy. In 2010, at the FOMC meetings, President Evans suggested a state contingent price level target. The core PCE increasing at 3% from December 2007. The proposal included a mock-up of potential FOMC November 2010 announcements, policy actions to achieve the target. Once the target achieved, switch to 2% inflation targeting over the medium term. There was also a statement there ending with the committee will take all necessary actions. Close to 2 years before President Draghi's famous whatever it takes. The proposal was not accepted. Had it been, we would have been quite a bit wiser today, I think. Anyhow, Ben Bernanke suggested more recently a temporary price level target where the FOMC would announce that in the future, if the policy rate would be at or near the effective lower bound, a necessary condition to raise the policy rate would be that average inflation since the policy rate first hit the LB would be at least 2%. So this is a temporary price level target, coach in inflation targeting language. It's a compromise between raising the inflation target permanently and having price level targeting permanently. And it should work if it is sufficiently credible. But it would be applied occasionally and temporarily. The private sector may not be used to and understand it if they suddenly see it. Considerable explanation and communication may be necessary. It may still not be sufficient for credibility. A permanent compromise may be preferable, perhaps average inflation targeting. Okay, finally, average inflation targeting. I pick 5 years as just an example of the averaging period, just to have something to talk about. So pi bar there is the average, the 5-year average inflation at an annual rate. I have actually proposed this for Sweden to avoid the downward inflation bias that you saw previously. I've also suggested it to the ECB as an interpretation of the phrase without prejudice to price stability. There is a great paper by Nissen and Westin, pronounced Westin in Swedish, about average inflation targeting. And more recently, President Williams, in speeches and in a working paper, have looked at average inflation targeting. So the loss function, actually one can think of a more flexible loss function, allowing for weight both on the 5-year average inflation target and some weight on the annual inflation target. So this is a more flexible loss function. Deciding on the weights is actually a somewhat tricky issue. Okay, so in mitigating deviations of a 5-year average inflation rate, the FOMC would try to prevent persistent over or undershoots of the annual inflation rate. If average inflation for the past 2.5 years is below the target, average inflation for the next 2.5 years would normally be above the target, while always taking into account the outlook for the labor market. We're talking about flexible average inflation targeting here. Central banks seem to have a somewhat irrational fear of overshooting. I'm not mentioning any names, but I think several central banks have displayed such a fear. Average inflation targeting would normalize overshooting and perhaps help overshooting and undershooting would be normal so as to make up for past misses and would help against this fear. Also, it's for this 5-year example, it's similar to having a 5-year price level target path, increasing at 2% starting today. If the effective lower bound would start to bind, one could just keep it as it is, or one could extend the shift to an indefinite horizon, more similar to the proposals of President Evans and Ben Bernanke. On the other hand, there are some issues with having too long horizons, so one may want to limit that. But anyhow, one has that flexibility. I believe that there are some advantages of average inflation targeting over the alternatives. Over temporary price level targeting, when the effective lower bound binds, it would be operating all the time. The private sector would see it in continuous operation. More likely, it would be well understood and credible. And if the ELB binds, one can, if one wants, extend the horizon. Over price level targeting, it's a smaller step. There is considerable continuity with annual inflation targeting. You're just averaging over several years instead of 1 year. That is pretty easy to explain. Also, but still, it is a halfway step towards price level targeting. And so it's quite flexible. You can have some weight on annual inflation. If it's successful, you can choose to extend the averaging period, getting closer to price level targeting. If it's less successful, you could shorten the averaging period and get closer back to annual inflation targeting. So it's quite flexible, has several options, and it's a modest step away from an annual inflation targeting, and can be a longer step eventually if it works well. There are several issues that need consideration and are left open in my paper. The choice of weights, the mu and the lambda in my loss function, what is meant by a balanced approach when you have average inflation instead of annual inflation there. Something I discuss a little in the paper, I haven't discussed here, is whether you would need some escape clause for some situations. For instance, if you have overshot so average inflation is above target, if you don't have good credibility, it could be costly to bring it back down, depending upon the nature of this disturbance. If it's a supply shock, for instance, and you have less credibility, it may be costly. So you may want to consider whether you need some escape clause and for what situations they would apply. The UK overshoot is an example, for instance. After that, should you have brought the price level back to target or not? On the other hand, if you have credibility, it's not really that costly to bring it back. So it all depends. There are several issues that remain to be examined here that I have not resolved in my paper. So my conclusion is that first, a good general strategy to fulfill the mandate is forecast targeting. And the Fed is to considerable extent already doing it. Among the specific strategies, I find that average inflation targeting has some advantages over the alternatives. But some issues remain to be resolved and need careful consideration. Thank you.
First, let me say thank you for inviting me to participate in this event. The questions addressed are very important, and it's an honor to be able to contribute to the discussions today. The paper by Lars Svensson provided an excellent and thorough review of the literature on alternative specific strategies for the price stability portion of the Federal Reserve's dual mandate. So before I get started today, the always important caveat. So the views that I'm going to be expressing in my presentation today are solely mine, and they may differ from different official Bank of Canada views. No responsibility for them should be attributed to the Bank of Canada. So the main takeaways from Lars's presentation, he argues that forecast targeting is a better general strategy. The document defines specific strategies using loss functions, and I actually like this approach because I find it clarifies the difference between longer-term strategies and the setting of the policy rate to achieve those objectives. Among specific strategies, he talks about how average inflation targeting and price level targeting can have some advantages and average inflation targeting is a smaller change than price level targeting, but there's still some items you need to think about. So in my presentation today, I'm going to focus on those two areas that I'm circled. That's the if part, and also I'm going to talk a little bit about the averaging period for inflation and the temporary versus permanent nature of price level targeting. Oops, I think I went too far. Okay, so first, in terms of average inflation targeting, and price level targeting. So what's good about these strategies? Well, in general, people think they're good because in models they have some automatic stabilizing benefits, assuming that expectations behave, and here I've just written appropriately. And the other thing that's good about them is that they do achieve inflation that is on average close to the target, and that was a lot of what Lars's presentation was about. But there are some problems with these models. In particular, they're not particularly robust. What do I mean by that? I mean that under some different assumptions about expectations, the advantages of price level targeting decrease and can be worse than flexible inflation targeting. We've done some work at the bank in that area and found that result, and it's also in a result that was highlighted in the recent paper by Bernanke, Kiley, and Roberts. Whether price level targeting can actually beat flexible inflation targeting can also depend on the model, independent of the expectations. And that was another thing that came out in the paper by Bernanke, Kiley, and Roberts. Another potential issue with these strategies is that they're time inconsistent, to use the economic terminology. And so basically, would policymakers really want to tighten, for instance, if inflation was below the target, unemployment was rising, but prices were still too high relative to a price level target? And that sort of problem can enter in numerous situations for both price level targeting and average inflation targeting. So in the end, there are a few key questions that these models in the real world we have to think about. Can central banks actually engineer outcomes as in models given uncertainty? And can central banks manage inflation expectations to behave the same way they're frequently assumed in models? And so basically I'm going to argue, better not count on that. And so just as a starting point for talking about that issue, this is a chart that I pulled out. Now don't look at the first part of the chart because I can't guarantee that the inflation projections are always core PCE in this chart. But what they're showing is the red line is the core PCE inflation, and the blue line are the inflation projections that are coming out of the monetary policy reports to Congress. So those are lined up so that the inflation expectations and the actual outcomes are lined up here. And what you can see is, on the one hand, actually the forecasts are pretty good. And so that's nice to see. But the other thing that shows up in this picture is there is a bit of a lag in the inflation expectations process. So one of the reasons I want to raise this is because if central banks go to a regime like price level targeting or average inflation targeting, this is a big change. And so people have to really understand what's going on in the framework in order for the inflation expectations to adjust. And so the process of learning to get to that stage I see as a bit of a catch-22. Because if you announce a change to a policy where you're going to be starting to reverse some past errors, and the expectations part is really key, then in a sense you want the central bank to be showing that right away and having the forecasts going up sooner than they would in a different environment. But then if the public sector doesn't immediately form their forecast the same way, there's going to be a problem, because then you won't actually get the inflation outcome that's close to that forecast. But then if the outcome's not close to that forecast, it's a little bit difficult to argue that the private sector is going to jump on the bandwagon and start believing those things in the future, because there's a problem there. So there's a certain degree of both sides have to simultaneously agree on the new world in order for these advantages of the automatic stabilizer properties to work. So I'm going to throw up a little terminology here, and this is only because I wanted to save words on my subsequent charts. But it can also show how to the general public these issues can get a little bit confusing, because there's inflation, there's an inflation target, there's long-run expectations of inflation, which I think are particularly critical for the definition of credibility. There's expected inflation, which most of the time in these models we're talking about short-run expectations in the near term. Then there's average inflation. Now, average inflation, even here, is a little confusing, because a lot of the times in models, average inflation is the entire history. But now we're also talking about an average inflation target where we're defining a shorter horizon. So that can be a little confusing. And then in the models themselves, we have this thing called pi star. And if I have a chance, I'm going to get to that issue at the very bottom, at the very end. So first, in terms of thinking about temporary price level targeting versus average inflation targeting, both of these are now in the temporary world. So I'm disregarding the non-temporary world because I think that there are too many robustness and time inconsistency issues. So now I want to think about these temporary price level targets or average inflation targets. So shorter horizon on average inflation targeting brought in general because of the lower bound issues. And so here, these sorts of temporary policies mean that when you're away from the lower bound to interest rates, your baseline framework is going to be remaining in place. When you're at the lower bound, however, you're going to put some weight on reversing past misses. And so, for example, that could be something like, don't increase policy rates until average inflation over the past year, over the past 2 years. Again, in some recent work by, in that Bernanke paper, the shorter horizon worked a bit better, but I think there's still room for discussion. Either way, it's a don't raise rates until after you've actually seen the inflation. And at least some of this period has to be in the past. It can't really be one of these forward-looking average rules when we're talking about temporary, because the whole point here is to be correcting some of those past misses on inflation. If it was low, then you want it to go high again. So that's what the definition is. Why might you want to consider temporary price level targeting or average inflation targeting, even if there were some problems with the main ones? And I would argue that basically, even if expectations don't behave appropriately, these policies are more robust and less time inconsistent. The policies can achieve average inflation that's closer to the target. And I would argue that that's something that can help credibility. I still read, just recently, I read someone was being quoted in the newspaper, was criticizing the Federal Reserve for not hitting their mandate. Because, look, inflation's been low for a really long time. But in a world where you're always trying to bring inflation back to 2, what's happened in the past is not actually an indication of whether or not the mandate is being fulfilled. And that actually can be a credibility issue when there's been a persistent miss in one direction or the other. I think also that these 2 policies can actually help the public understand policy when the interest rate's at the lower bound. And I think that these 2 policies can be a good risk management tool in a world with a lot of uncertainty. So now I'm going to explore in a little more detail some of these issues. So here, I always like to think of credibility as actually being that the long-run expected inflation rate is anchored on the target. And so then the problem with the lower bound is that average inflation will tend to be less than inflation under a flexible inflation targeting framework. And this could lead the long-run expectation to drift downward away from the target. And so that's the issue with the lower bound. Now, practical considerations, do bring some questions into how much of a problem this could be. And I'm not saying we should totally disregard it. I just want people to realize that when you actually look what's been happening, long-run expectations lag inflation at longer horizons, and the sensitivity to inflation gaps tends to decrease with the length of horizons. So those long-run expectations take a pretty long or persistent deviation to be pushed around. And a lot of our evidence on what's happening in terms of these long-run expectations of inflation drifting are from a period before we had explicit price objectives. So that's another reason to think that even if inflation was to go up a little or to go down, and we've had that experience, that doesn't necessarily mean there's going to be a big drift in that long-run expectations. Now, of course, again, practical consideration, there are questions about how to measure long-run expectations. Now, this first chart, main bottom line here is the credibility comment. You've got that there's a history here of inflation on a red line. There's a history here of survey expectations of inflation, plus there's a backward extrapolation that goes prior to roughly the early 80s. And that's the blue line. And so you can see pretty clearly, this to me is a diagram of credibility being earned. At the end of the chart, I've got two other measures of expectations. They're both not perfect because they're break-even inflation rates or five-year forward inflation expectations, both from financial markets, so they may have some slippage. They're not necessarily pure expectations of inflation. But they do give different measures. And so that is, again, another practical consideration that if trying to get too precise, there's always going to be a little bit of a challenge on the measurement side. And this just gives that example for the long-run expectations. Now, one of the reasons, again, in thinking about the temporary price level targeting is it can help get the average inflation a little closer to the target, and that can help with credibility. So the way the temporary price level targeting and average inflation targeting works, in a sense, is by delaying the increase of the policy rate from the lower bound. That also does increase the likelihood that inflation would overshoot. I mean, that's part of the idea, to get average inflation closer. Now, my comment here, I've already basically said this, but small overshoots I don't think are something that should be a particularly large concern. They'd have to be large or persistent. Policy can react. I mean, we're observing inflation. There are signals of inflation expectations. And so that gives time for policy to react to overshoots if there's a concern that they might continue to be growing. But overall, even some of those overshoots, if there's been a long period of inflation below target, some of those overshoots themselves are not just on the average inflation piece, but in terms of the temporary piece, but can also just help more generally get the average outcome. Then I do have to throw the caveat here. This session isn't about price stability, but one concern with lower for longer periods is that, financial stability. There could be buildups of financial imbalances in lower for longer policies, and so that is something that needs to be monitored, but I'll leave that issue for another session. So I think another issue to think about in terms of these temporary policies is, in a world with uncertainty, I think of them as having a risk management strategy in place. They can help balance some of the risks in our understanding of the relationship between unemployment and inflation. And the general argument here is when you're at the lower bound, this is also generally the case when inflation has been low relative to target. And so as a policymaker, it's a little bit better in that world to be accepting the risks of an inflation miss on the upside than an inflation miss on the downside. So from a risk management point of view, there are some arguments to holding the policy rate a little low for longer. And again, this is a world of uncertainty. So what I have in this chart that I'm showing, the green line that varies a lot is the unemployment rate. The smoother line is an estimate of the non-accelerating inflation rate of unemployment or the natural rate of unemployment that was in the 2012 board staff estimates. The red line is spliced from different sources, but it's an real-time estimates of that same concept. And so that sort of jumps around red line. Prior to roughly 1989, it's actually coming from the CBO, the Congressional Budget Office. After that point, it's coming from Federal Reserve sources. But the point here is that there are times when, subsequently, we actually think the sizes of these gaps were half as large or twice as large as had been previously estimated. And so this is just giving one way of looking at our degree of uncertainty about this model that's pretty important in terms of our understanding of inflation. So I think another argument for thinking of some of these policy decisions when you're at the lower bound is that at the lower bound, the policy rate's not moving, right? So it makes it look like policy is actually insensitive to data. where in fact policy is very sensitive to data. And so one of the things that these temporary policies can do is they can try and reinforce the data dependency ultimately of the policy decisions. Now, even in this world, it's always going to be important to think about flexibility. I've been talking about temporary price level targeting and temporary average inflation targeting, but there could be other natures of the temporary thing here. We have seen statements related to the unemployment rate, for instance. And so the concept can be generalized. Flexibility is going to be necessary. And part of the reason I put this in is the UK example that was actually given by Lars. I mean, going into a situation where you think there's going to be a really, really bad recession, but inflation is high, perhaps because of depreciation of a currency. That's not a time to be saying, oh, we're going to be leaving policy low until inflation's above 2. Inflation's already above 2. But inflation's expected to be weaker, or the economy's expected to be weaker. So even these temporary policies have to have some flexibility. But I think the important thing is that they can bring back a little bit of data dependency. So I'm out of time. This is more of a technical slide, but I think the thing to get to this is when people are talking about these in models, they start talking about, well, if the average inflation rate's different from the target, should we be doing adjustments to the rule? And then this is all ultimately in a world where, in fact, that model's not going to be the truth because all models are approximations. There are model limitations, there's model uncertainty, data uncertainty. And so in this context, when we start thinking about really complicated manipulations, it makes me wonder if maybe some of the practices by other central banks, like the Reserve Bank of Australia, might be worth considering. Because this is a world where they're really putting more emphasis on a range. When things get close to one end or the other end, they want to bring it back to the middle. But they don't necessarily go and try and always say, we're trying to get back to the midpoint of the range. It's always targeted on the midpoint. They say, on average, over the medium term, you should be expecting inflation is closer to the range. So as a communication tool, in addressing what may be some of these technical pieces, I think that last strategy and perhaps putting a little more emphasis on a range would be another approach to addressing some of these features. And I'll stop there. Thank you.
Thank you, Sharon. Thank you, Lars, for both of you for a very clear, consistent, analytical framework to think about monetary strategy. Classically, however, strategy is defined as aligning means with ends given changing and occasionally hostile circumstances. It's not just what's optimal over the long term. And so, and in your models and in Lars's paper, it's made very clear that as you put it, credibility has to be earned. That the benefits, the full benefits of an average inflation targeting regime or a price level targeting regime, temporary or otherwise, would take time to be learned and assimilated, even under, as Sharon puts it, appropriate expectations. However, as Chair Powell opened the conference yesterday, and many of the distinguished Federal Reserve Open Market Committee members have said through the preceding months, we're in a world of low R-star, we're in a world with downside inflation risks at a very low level, and I would go further and say that one message of the FedListens, talking to real working people and real businesses and small businesses, is that politically, I don't think we want to imagine all that might happen if we have another severe, sharp recession very soon. And so I guess what I want to ask both of you before we turn to the floor is there anything we can do to get inflation expectations up ahead of the next recession beyond announcing a average inflation target or a price level target and letting it unfold? If we take seriously the Phillips curve estimate and the Eberle, Stock, and Wright paper from yesterday, which is very typical and reasonable, it would take an awfully long time to get a meaningful overshoot of inflation. So is there anything we can do to raise price expectations, inflation expectations in the shorter run? Is there anything we can do to get a faster recognition or reaping of the benefits of the regimes you're talking about?
Okay. May I also say, respond a bit to...
Yeah, but why don't you respond to my question first?
Okay, I mean, first, if you announce a new, somewhat different policy regime, when you think about it, when we introduced inflation, okay, let's focus on this inflation expectations issue. I think just announcing the policy, the new policy regime, average inflation targeting, suppose you take 5 years, that may not in itself move expectations very much. You may have to do something. And of course, if you have run 5-year average inflation below target, what you need is to get annual inflation up above target. So you may need to take policy actions to get actual inflation towards above overshoot. You can see, in a way, you can think of average inflation targeting is to normalize over and undershooting, letting annual inflation over and undershoot the target, so as to keep the average inflation closer to target. And once you explain that this is normal, this is a normal thing we do, more likely expectations will adjust. And one can add that what we want, if we're successful, is not just that expectations shall be anchored at the inflation target. We want, of course, long-run inflation expectations to be anchored, but we actually want short-run expectations to move around a bit and occasionally be above target, so as to short-run inflation expectations to be above target, so as to help actual inflation, the average inflation, getting closer to target. So we want a more active role for short-term inflation expectations, and use that channel in a flat Phillips curve to affect. I think if you take into account the second problem that was emphasized in the beginning of the conference, the flat Phillips curve, using inflation expectations as a channel. If we can get there, it's great progress. Also, I think we should remember the skepsis that inflation targeting met when it was first introduced in New Zealand and in Canada. In international gatherings of central bankers, New Zealanders and Canadians were laughed at because they would make fools of themselves. Eventually, everybody agreed that they were doing the right thing. And also, in some cases, it took longer to get credibility for this story. Sometimes it went relatively fast. One doesn't know until one tries how soon you can get reasonable credibility for the new regime.
Thank you. Sharon, do you want to say anything on this?
Yeah, so I guess in the context of, if things were to turn bad and inflation was to start falling, I think the policies that we were talking about today are things that could help get interest rates down further and faster. Not so much overnight interest rates, because that's in direct control, but it's the longer term rates. And this came out in some of the discussion yesterday, that it took a while for people to believe in the persistence of the low rate. Now, maybe just having that experience is enough, and some of these additional policies wouldn't be necessary, but I think these policies could help reinforce getting rates down lower and faster. In terms of raising actual inflation expectations right now, a lot of my own past analysis on US inflation suggests that expectations tend to move with a lag relative to inflation. And so in that sense, I think the thing to be focusing on in communication, and hopefully this would help adjust expectations on the inflation side, is the progress that is being made on the labor market side, where it's been slow, but wage gains have been on a gradual uptrend and are looking better. And that is ultimately one of the key inputs onto the pricing side. And so I think it's the advances in the labor market as part of the message that is providing, some confidence that inflation is going to be getting back more sustainably towards 2. And as people have more confidence, I think that'll help the expectations and reinforce the process. But there's no magic bullet.
Thank you, Sharon. Lars, I'm sorry to have interrupted the normal flow. Please respond to Sharon's discussion.
Okay, let me just add one little point to the previous issue here. Suppose the SEP would show that the FMC participants all predict that inflation will overshoot the target for the next 3 years. I mean, a half or 1 percentage point. This would be discussed and commented on a lot. And certainly the market would get it. And I mean, the attention, it could be more effective than we think. Who knows? But anyhow, okay. I thank Sharon for her very interesting comments. And of course, these are things that our Canadian friends, Sharon and others, have thought about more than many other central banks. So her comments are very insightful and should be taken seriously. Still, I think, I mean, the basic point is that we want inflation expectations to be a bit more active and help the Federal Reserve to fulfill its mandate. And when you think about it, explaining to people, look, we have actually had average inflation below target for a while. So now we need annual inflation to run above the target for some period in order to maintain our average inflation. I think that is pretty easy to explain and should be understood pretty widely. And it's not so far away from the current annual inflation targeting. And if Sharon brought up the UK situation when inflation was above target and unemployment was high. Of course, that is not a situation when you should bring inflation average or annual back to target. If unemployment is high, inflation should continue to be high. It's only later on, when unemployment has come down, that you would want to get back to target with inflation annual and average. So there is no hurry in getting back. The Brits could have continued quite a while. And I mean, they did until until unemployment came down quite quickly, actually. Okay, let me end there.
Great, thank you, Lars. So I'm going to follow Hyun's model of a moderator. I'm going to divide the room into 4 Federal Reserve districts. So to the left of the gentleman with the beard is one district. To the right of the policymakers here is another district. And then over here, I'll start with the far district over there since they were last time. So you're on the wrong side of the line, I'm afraid. You'll be in the next batch. So yeah, the 3, please. I see gentlemen, and I'm too nearsighted to make out who. Please identify yourself.
Thank you. I'm Ethan Harris from Bank of America. So I wanted to ask the panelists about a slightly different inflation targeting regime that I think kind of addresses a lot of the issues, but does it in a way that's a little simpler for the Fed. I was struck by a comment from Chair Powell earlier this spring where he said, we need to think of ways of making that inflation target highly credible so that inflation averages around 2% rather than only averaging 2% in good times and then averaging less than that in bad times. And I thought what was important about that quote is it's really tying monetary policy into the business cycle in terms of the way you target inflation and recognizing that there's these nonlinear events called recessions that create very high unemployment rates that need to be made up for later in the business cycle if you're going to have average inflation of 2%. So what I'd like to ask the panelists is, doesn't it make sense to have a much more simple framework where you announce that the Fed finds acceptable inflation as low as 1.5% during the so-called bad times, and that during good times they want inflation, say, of 2.5% or some kind of a clear overshooting kind of statement? Because I think that approach is more time consistent than inflation averaging. It's something the Fed can commit to. It's simple to explain to the public. It doesn't overpromise. And it brings the business cycle into discussion. This idea that inflation is low early in cycle and therefore has to be higher late in the cycle into the mandate. So I wondered if I could have comments on that kind of alternative. Thank you.
That Mickey, and then the gentleman in front, 2 rows in front of him. Sorry. Okay.
We're going out of order.
Yeah, fine.
Eric Sims from the University of Notre Dame. This is a question for Lars. You mentioned it at the beginning of your talk, the appendix about nominal income targeting, and I was wondering if you might elaborate upon that a little bit. I fiddled around a little bit with that in some different contexts, and it's true in kind of the textbook model that I think you're working with just a price Phillips curve. It doesn't look so good. But there's frameworks that, for example, if you introduce a wage Phillips curve in addition to a price Phillips curve, nominal income targeting in that framework suddenly looks a little bit better. So I was just wondering if you could elaborate on your thoughts on that.
Mickey Levy. So Lars, your focus has been inflation targeting, and since the Fed put in place its official target at 2%, the Fed has persistently forecast inflation is going to go to 2%, but of course inflation has been shy of that. Are we seeing any evidence that the inflation below 2% is harming economic performance? And if inflation were to continue to hover slightly below 2%, particularly in light of the way the BEA incorporates quality adjustment estimates in measuring inflation, will we be concerned, with the exception of the concern about the zero lower bound, should we be concerned about inflation being slightly below the Fed's target as long as the Fed continues to forecast inflation going back to 2%?
Please.
Okay. First question, whether one should be happy having inflation below target in recessions and above target in good times. I mean, ideally, you want the opposite. If you want to stabilize, you want high inflation if you have high unemployment, and lower inflation when you have unsustainably low unemployment. So ideally, you want exactly the opposite, because this way you stabilize unemployment better. Okay, regarding nominal GDP, I wondered whether I should make it a separate section or not. But the reason I don't think it's a serious contender is pretty straightforward. I mean, the dual mandate means that there are 2 objectives. I mean, employment, maximum employment or maximum sustainable employment, and stable prices. They are 2 separate. You want to achieve both. Getting one is not enough. If you take a nominal income target, you have essentially one target, nominal income. Then you have a 1-to-1 trade-off between prices and GDP. So low employment and low GDP and high unemployment is fine if you at the same time have high prices. That makes little sense to me. We have two targets that we want to achieve, not one real and one nominal target. So the idea that lower GDP and employment is fine as long as prices are higher, I think contradicts the essence of the dual mandate. That's a more formalistic argument. Then there are practical ones. I mean, the data, the GDP deflator and GDP are available with a longer lag, whereas prices and unemployment are available within a month with a high quality little revisions. We have big revisions of GDP and the GDP deflator, and also a longer lag. So those are standard practical objections to nominal GDP targeting. One could also say that there are some delicate issues whether people will start interpreting distinguishing between nominal GDP and real GDP is not that easy for the general public. There are a few more potential problems. So I don't think nominal GDP, when now we're probably talking about nominal GDP level targeting, nominal GDP growth targeting has the same issues. So that was my response on nominal GDP. If we didn't have the ELB problem, I mean, in principle, it wouldn't be a problem having an inflation target equal to 1.5 or maybe even 1. There are issues of downward rigidity of nominal wages that start playing when you get too low, though. But I think it's really the ELB that is now the main issue and the reason why we're concerned. Also, having a situation when the forecast would always go to 2%, but the average would be lower at 1.5, is not satisfactory, and eventually inflation expectations would anchor at 1.5, and it doesn't look good when you always miss your forecast, always exceed the outcome. So I don't think it would be a satisfactory outcome.
Sharon?
So I just wanted to add one comment onto the first question, the idea of accept as low as 1.5 in bad and 2.5 in good. And that's really a variant of what I was talking about that the Reserve Bank of Australia is doing, where the focus there is more on a range for inflation. And as long as things are within the range and moving generally away from the borders, then things are regarded as good. And overall, the thought is that the average should be pretty close to the middle. And they've had some success with that, and that was actually in Lars's paper in the chart that he showed. So that really becomes, again, I think of that as a little bit of a communication strategy that I think is consistent with a policy that's exactly as you described. It's, it could be a 1 to 3% range the way we have in Canada. We still have a little more emphasis on the midpoint, but it's easier to soften that up and allow for overshoots and undershoots when the emphasis is on the range instead of the midpoint. The critical issue is the anchoring of expectations, and Australia has not had a problem with that.
Just brief.
I'm a little skeptical relative to Sharon on having a range, 2 to 3 or 1.5 to 2.5. Because you really want inflation expectations to, on average, be in the middle. There's a big difference if you have inflation expectations at 2 or at 3, at the lower end of the range or at the upper end of the range. So I think having a point target brings more focus and makes it easier for people to anchor their expectations.
It's interesting that as we approach 30 years since New Zealand and Canada, no one has decided whether a point or a range is the optimal yet. It's a real issue. From the Central District, the gentleman on the border, President Bullard and President Evans. So please.
Hi, Evan Koenig, Dallas Fed. I want to sort of pick up with what Eric Sims raised, this question of nominal GDP targeting, and push on that a little bit harder. It's pretty clear that if price stickiness is your only nominal friction, you're going to end up with something like flexible inflation targeting or flexible price level targeting as your optimal policy. As Eric mentioned, if you have sticky wages, that changes, and nominal income targeting looks better. I think that in the real world, people have fixed nominal mortgage, auto, and student debt payments. And what they want as much or maybe more than stable prices is a predictable stream of nominal income. The only way to get that in the aggregate is if negative output surprises are accompanied by positive price surprises. And that's exactly what nominal GDP gets you. So I think if you have that sort of nominal friction in the economy, nominal wage stickiness helps, makes nominal GDP targeting look more attractive. These nominal obligations, nominal debt obligations, also make nominal GDP targeting look more attractive. And I think this ties in with financial stability considerations. So it may or may not turn out that nominal GDP targeting is the solution, but I don't think it should be dismissed.
Why don't you guys just respond directly to that, because that's so clearly a follow-on.
I'm well aware of that argument, and it doesn't convince me. I think issues with household debt and so on should be handled with macroprudential policy, and monetary policy is usually not a good tool to handle these things. And the idea that you should formulate your monetary policy strategy and give prominence to nominal GDP targeting for this reason, disregarding the dual mandate, makes no sense to me.
Sure.
Nominal GDP targeting is one of the frameworks that we're looking at in the context of the Bank of Canada's renewal. And so it is something that I think is worth considering. Some work at the Bank of Canada way back in the 1980s suggested in the models that we had at the time, the nominal GDP targeting was actually probably the best way to go. And it was really more a communication issue that led to price level targeting. I mean, there are some challenges when nominal GDP is strong, saying, wow, income's too good, we need to tighten policy. And so there is something on the dual mandate when you can emphasize inflation more when the unemployment rate's low, and when the unemployment rate's high, you can talk about trying to bring that down. So there are some nice things about the dual mandate from a communication side, and jobs, I think, are actually closer to people than nominal GDP, though I certainly accept your point on income.
Thank you. President Bullard.
Jim Bullard, St. Louis Fed. So I'm going to pile on with Eric Sims and Evan Koenig on GDP targeting, because I think Lars is off base here. He just said that we should have high inflation in bad times and low inflation in good times. That's exactly nominal GDP targeting. You would want the high inflation because that's going to lower the real interest rate more exactly at the time when you need it. If you read the appendix, it says that there's no model that is going to tell you that nominal GDP targeting is optimal, but both Evan and Eric have named models, and I've got another one, my own model, that says that actually nominal GDP targeting would be first best. In that model, the friction is nominal contracts, and so if you go that direction, you're going to certainly have a framework, one in a sea of possible frameworks, but at least one framework which says that nominal GDP targeting is optimal. So it's worth mentioning for the group here that Kevin Sheedy's work says that the nominal contracting friction is 9 times more important than the sticky price friction. So I think this is certainly an area for future research. If you read people like Martin Schneider about the amount of nominal debt that's out there and the reallocation that's occurring when surprise inflation occurs in the economy, is very substantial. So I think I love a sticky price model. I've used it myself over and over again, but I also think that we're overcommitted to the sticky price friction, and we should think more broadly about other frictions and what that would imply for monetary policy. Lars also brings up practical concerns about nominal GDP targeting, which I think are entirely relevant, and I agree with that. But those practical concerns are mostly measurement issues and would apply to other frameworks as well. I have a different question for Lars, which is on forecast targeting versus Taylor-type policy rules. Lars says that forecast targeting is good because it takes into account all available information, which I think is a very powerful argument, but that extra information includes judgment about the economy, and that seems like an out to me. Judgment sounds like discretion to me, where you can say, well, the numbers don't really add up to what I'm saying, but because of judgment, I'm going to do one thing or another thing, and then markets have to try to guess what this judgment factor is, and they might have their own judgments about what's going on, and that seems to me like you could spiral away from the targeted equilibrium because you're allowing a lot of discretion. So this sounds like a backdoor way to get discretion back into the model, and maybe that's not such a great idea. The whole point of Taylor-type rules is that you're pinning down what the central bank is going to do. This pins down expectations, and this informs the equilibrium.
Thank you. Maybe, Sharon, you go first this time, and maybe, unless you have something totally new to say on nominal income, focus more on Jim's second question.
I was actually just going to say, in terms of the nominal GDP targeting, I think another important reason it's on the table is the issue of what is the neutral interest, what is R star? And in that framework, when you don't know R star, you basically are allowing the inflation rate implicitly to absorb that difference. But then a question that I would have is, if that's the case, if there's variation in R star, then to what extent do you get drift in the inflation target? So those are other considerations that need to be thought about.
Any comment on sneaky discretion by using forecast targeting?
I think there's a certain degree of reality in the fact that monetary policy is always going to have some judgment in it. And so if the purpose of forecast targeting is to find a way to introduce discretion, then we have an issue. But if it's just acknowledging the fact that there is always judgment involved, then it's less of a concern.
Lars.
Okay, on this one brief thing about nominal GDP targeting. That means that there is a unitary marginal rate of substitution, excuse me for being a little technical, between GDP and prices. And there is no reason why that one should be socially optimal, nor is there any reason why that being constant should be socially optimal. The more natural thing when you have two separate targets is that you have an increasing marginal rate of substitution or an increasing marginal loss of deviation in each variable separately. But I realize I should have made nominal GDP targeting one of the sections and talked more about that during the presentation. I'll see what I do in the revised version of this paper. On the role of judgment, I mean, any practical policy maker, monetary policy maker knows that judgment is extremely important. Models are always imperfect, and you have a sequence of models, each one with its set of simplifications. You can never trust models completely. You always need to use your own judgment and your colleagues' judgment in the committee that decides. Because each model is an extreme simplification, takes into account only a few pieces of, a few of the variables and a few of the pieces of information that matter. When you have a crisis, I mean, financial crisis is not in Phoebus. When you have large-scale asset prices, you need to take that into account. The optimal policy projections that I showed very briefly from the Thiel book a few years back are all conditional on particular assumptions about large-scale asset purchases, which I understand are introduced in various ways to add factors in the usual way. Bob Tetlow and I have a nice paper, I think, which deals with these things, which actually formalizes a bit the optimal policy projections that the Fed were doing at the time. So I think there is no way we can do without judgment. The way to handle discretion is to be more committed to our objectives, to be committed to our objectives. Also, I mean, there are time consistency problems.
Speaking of which, please. Just another historical footnote. When 20 years ago writing about inflation targeting, a number of us were writing that inflation targeting was a way of disciplining discretion. not a way of sneaking in discretion. Now times change, but it's interesting that that's the progress that's happened. The last word for the session before their replies goes to our host, President Evans.
Thank you. I think that the paper by Lars combined with the first paper yesterday by Stock, Eberle, and Wright are a really good combination. And I want to suggest that we really need more work on analyzing time-varying effects of central bank credibility in all of our analyses. That is, the FOMC, we submit a summary of economic projections quarterly, and we all are instructed to assume appropriate monetary policy in order to achieve the outcomes that we're supposed to be delivering. The alternative monetary policy frameworks that we're thinking about here are really an attempt to enhance credibility that appropriate monetary policy is going to be pursued to achieve these outcomes. So whether it's a new framework, it's a very simple level, or it's just continuing with the existing framework in the US, I think that credibility is really the big banana, whether or not you can deliver on do whatever it takes. And so sort of in the context of yesterday's paper, the question that I would have is, if you had a dummy variable or some type of indicator that allowed for, it's just assumed that the credibility of the Monetary Policy Committee and the chair is taken as given and constant throughout this. And I thought that John Taylor was able to be pretty critical in terms of what are the effectiveness of these tools, sort of without having to consider who the committee was and what was going on during that. So if you had an indicator that sort of pointed to whether or not it was Ben Bernanke in charge of policy, Janet Yellen, Jay Powell, Jean-Claude Trichet, Mario Draghi, Governor Shirakawa, or Governor Kuroda, I wonder what the analysis would be. And so much of what the frameworks are about is trying to get at the most credible policies. So I commend the authors of these papers, and I think more work can be done to shed light on that.
Do either of you want to comment on that, or just accept the kudos?
Comment.
I agree completely with the substance, of course, that Charlie expressed.
Great. Please join me in thanking our two speakers.
Thank you very much.